For the past 18 months, I've been conducting a real, fully self-funded experiment, and now it's time to share what I found. I opened actual brokerage accounts with Schwab, Fidelity, and Vanguard. I didn't rely on online reviews or test drive demo platforms. I moved real money, placed real trades, left cash idle, and contacted each company's customer support multiple times. The purpose? To answer a deceptively tricky question. Which of these brokerage platforms truly works best for everyday investors in the real world? Before we get into it, no, I'm not going to tell you which one is the best. That's because, frankly, none of them is perfect. Each platform has strengths, compromises, and behind-the-scenes practices that most investors never notice. I'll lay them out and let you decide which factors matter most to you. A lot of people assume that now that trading is free, it doesn't really matter where you open an account. But that's simply not true. The zero-commission model is mostly a marketing tactic. Behind the interface, these companies still make billions, just in ways that are less visible to the average user. This breakdown is based on 5 practical categories that actually affect your portfolio. What happens to your uninvested cash? The quality of the trading experience. What types of assets you're allowed to invest in? How reliable and accessible customer support is. And finally, who each platform is truly built for. Let's begin with something investors often ignore. Round 1. What happens to your uninvested cash? When you deposit funds into your brokerage account but don't invest them right away, what happens? Each of these platforms automatically sweeps that cash into a default holding account. But the interest rates you earn on that idle cash vary significantly. Here's what I saw during the test. Vanguard sweeps idle cash into a federal money market fund, earning about 5.28%. Fidelity uses a government money market fund, around 4.97%. Schwab, however, sweeps it into a bank deposit account, which earns just 0.45%. Let's put that into context. If you had $10,000 sitting idle, Vanguard would earn you $528 per year. Fidelity would earn $497. Schwab would earn just $45. That's a nearly $500 difference annually, with zero effort, simply based on where your interest is going. And this isn't accidental. Schwab profits massively from this spread. They earn the full market rate on your money, but pass almost none of it onto you, and keep the difference. Transfer and margin fees. When it comes to leaving one of these platforms, the experience is very different. Schwab charges $50 for a full account transfer. Vanguard charges $100. Fidelity charges nothing. On top of that, if you plan to borrow money to trade, known as margin trading, interest rates at Fidelity are generally lower than those at Schwab. So if you might ever use margin or switch brokers down the road, these fees and rates could seriously impact your total costs. Round 2. The trading experience. Let's now look at what it's actually like to trade on each platform. For experienced traders, the kind who use complex options, high-frequency strategies, or trade futures, Charles Schwab's Thinkorswim platform, originally from TD Ameritrade, remains one of the most powerful tools available to retail traders. But if you're not a heavy trader? Fidelity's web-based platform is arguably the best all-around experience. The interface is clean and easy to navigate. You get access to detailed research from over 20 firms. Placing orders is intuitive but highly flexible. They also offer Active Trader Pro, a downloadable trading platform, but honestly, the web version is great for most people. Vanguard, on the other hand, takes a different approach entirely. The platform is deliberately simple. The layout feels outdated, and the available tools are minimal. But that's by design. Vanguard promotes long-term investing, and they purposely discourage frequent trading, and their interface reflects that philosophy. Execution quality and transparency. Let's talk about trade execution, specifically, payment for order flow. This is a practice where brokerages sell your orders to market makers instead of routing them directly to an exchange. It's legal and very common, but it introduces a conflict of interest. Charles Schwab heavily uses payment for order flow. Fidelity and Vanguard do not accept payment for order flow on stock and ETF trades. Instead, they aim for the best execution possible. This doesn't mean Schwab is guaranteed to get you worse trade pricing, but over time, even a small execution gap can eat into your returns. Round 3, what can you actually invest in? All 3 platforms give you access to US stocks, ETFs, mutual funds. But beyond that, their offerings start to diverge significantly. Fractional shares. Fidelity allows fractional investing in over 7,000 stocks and ETFs. Schwab restricts fractional access to just S&P 500 companies. Vanguard only allows fractional investing in their own Vanguard-branded ETFs. International markets. Fidelity and Schwab allow direct access to international stock exchanges. Vanguard does not. You can only invest in US-based ETFs that include international stocks. Cryptocurrency access. Fidelity lets you directly trade Bitcoin and Ethereum, even within retirement accounts. Schwab offers indirect exposure through crypto-based ETFs. Vanguard blocks crypto ETFs entirely. They believe cryptocurrency doesn't align with long-term investing principles. Whether that's a deal breaker or a feature depends entirely on your outlook on crypto. Round 4, customer support. Customer service becomes crucial when something goes wrong, and differences here are real. Fidelity offers 24/7 phone and live chat support, with short wait times and US-based teams who resolve issues quickly. Charles Schwab still has decent support and even physical branch locations, but post-merger with TD Ameritrade, their wait times have grown longer. Vanguard has limited support hours, no branch offices, and often long waits, especially for more complex requests like estate processing or account rollovers. Customer support doesn't seem important until it suddenly is. Summary: what's right for you? Each of these brokerages is designed with a specific kind of investor in mind, and recognizing that match can help you choose wisely. Vanguard is best suited for long-term, passive investors. If you admire Jack Bogle's philosophy, have no interest in crypto or frequent trades, and just want rock-bottom fund costs, Vanguard is a solid fit. Charles Schwab caters to experienced traders who need powerful tools like Thinkorswim and are comfortable working around cash yield limitations or transfer fees. If you want customization and control, Schwab delivers. Fidelity strikes the best balance. It offers broad investment access, high-yield sweep options, fractional shares, crypto access, and industry-leading customer service, all in a clean, modern interface. If you value flexibility without complexity, Fidelity could be your best bet. But again, there is no clear winner. The right platform depends on your investing style, your goals, and your specific needs. So what should you do? Ask yourself, am I a passive investor or an active trader? Do I care about earning interest on idle cash? Do I want access to crypto, global markets, or fractional shares? How important is responsive customer service to me? Let those answers guide your choice. Final thoughts. This was not a sponsored review or a summary of marketing promises. It was a real-world breakdown of what actually happens when your money hits each platform. If you've had any personal experience, good or bad, with these firms, feel free to share it. Others can learn from your wins and mistakes. And if this breakdown helped bring you clarity, stick around, more practical comparisons and in-depth guides are on the way. Thanks for watching. Good luck.